Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the United States unemployment rate and the effect that it's likely going to have on the Federal Reserve and risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So we got the most recent jobs report today, and all in all, it was a fairly impressive jobs report with non-farm payroll coming in way overestimated. And I've seen various takes on that. Some people don't really believe it. Some people say that we just need better seasonal adjustments and whatnot. But regardless, at the end of the day, it's important to know what effect did it have on markets, right? So 3.4% marks a new secular low, for this cycle. Go take a look at where the unemployment rate has been. And really, it's been between 3.5 to 3.7% for basically last year. And now we're all the way down to 3.4%. To find the unemployment rate as low as 3.4%, you'd have to go all the way back to 1969 to see it that low. Okay? Now, why is that something, worth talking about, right? Well, all the way back over here, when it got down to that level, it actually stayed there for like a year or so. And then eventually the, you can see the stock market hit sort of a major top right here and then slowly went down. But one of the reasons it went down back then, of course, we know is because inflation started to go up. So this brings us to our question, right? Well, does the unemployment rate going down, is that more likely to make it so the Federal Reserve will raise the terminal rate, the Fed funds rate? And the answer to that, according to the markets, is yes. Now, the jobs report, it might seem like it's only, it's bad news in terms of where the terminal rate is going to be, meaning it's going to be higher. But there was some positive developments. The in terms of wage inflation or wage growth, we've actually started to see it moderate some. So it's not, so that one of those things that the Fed is the most worried about has actually continued to moderate. At least here in the short term, right? We don't know what it's going to do 6 months from now, but at least here in the short term, it's moderated a little bit. So you have a tighter labor market, but the inflation component, which is arguably what the Fed cares about, has actually started to come back down. It's continued to slowly come down, right? So that's just something to keep in mind. It's not the worst report in the world, even though the labor market has gotten a bit tighter. With that said, what do the markets think of this with regards to the terminal rate? Well, if we go take a look, let me reload the page because this is updating every minute, it seems. Now, for March, the market is saying about an 82% chance of another 25 basis point rate hike. 82%. But what's more interesting is if you go to May. And right now, there's actually a decent probability of another 25 basis point rate hike, which was not really the most likely outcome just a couple days ago. If you go over here to the compare tab and take a look at the probabilities. So on January 3rd, the likelihood that May was going to see that 25 basis point rate hike was only 40%. And then on January 27th, it went down to 33%. And then on February 2nd, it was as low as 30%. But after the most recent jobs report, that number has shot up to 48%. So clearly the markets think that, there's reason to believe the Fed could go higher than it was originally priced, than it was originally priced in terms of the terminal rate. So it'll be interesting to see how these numbers change throughout the coming weeks. And I imagine the inflation component will, the inflation report that we'll get in a little over a week from now, like 10 or 11 days from now. I guess it depends on when you watch this video, but it'll depend on where that comes in. Do we continue to see moderation in the inflation rate? Is it coming down in a linear fashion? Is it somewhat sticky? We'll have to see. But so far, we can see that the market, at least in the short term, has considered this jobs report to mean the Fed is likely going to go higher than what was initially priced. Okay. If you go out to June, you can see the most likely outcome is only 5%. July, it's 5.25. So you can see probabilities all over the place. But if you go out to November, the market is here at 5, and then December back to 4.75. So The market is still expecting some cuts. If you go to the probabilities tab, you can kind of see the blue here shows the most likely outcome for each month. You can see it's 82, then 48%. So 82% for another 25, then 48% for another 25, and it's kind of all over the place. But then by the end of the year, the market thinks you're going to see a couple of rate cuts. All right. Now, the only way I think you're going to see rate cuts is if something in the economy starts to go wrong to make the Fed want to cut, because the Fed's already been clear that they don't really want to cut this year. So if the Fed's wrong and they are going to cut this year, it means that something, there's got to be something that would make the Fed pivot. And at this point, there's just nothing really that's going to make the Fed pivot. And we said before, right, you can look for signs of a recession in 1,000 different indicators, but the only place that really matters is the unemployment rate, right? I mean, if the unemployment rate remains at a secular low, I don't think you're going to see the Fed blink in any way. So again, you can find the signs of a recession, just don't look in the one place that matters, right? And that's the labor market. And until the labor market softens up, I don't think you're going to see the Fed become too much more dovish. Right now, they might just get to their terminal rate and then pause, but I don't think you're going to see them cut rates until something really starts to slow down in the economy, which according to the labor market has not yet begun to occur. Now, if we go take a look at inflation overlaid with the unemployment rate, you'll see that with the unemployment rate over here in the 60s, it was not a good thing for inflation. So inflation started to go back up at that time. So you can see inflation was going up in the mid 60s, and then it started to come down a little bit in 67, and then it started, it went back up to the upside as the unemployment rate continued to come down. Right now, the unemployment rate's coming down, and I imagine the Federal Reserve would like to see this continue to come down. And in fact, I think for the first time, Powell said that we're now seeing signs of disinflation, and the market really liked that news, and the market rallied on that news because the market, of course, wants to hear Powell, who is going to be very reserved in what he says, mention that, at least acknowledge that there's some element of disinflation going on. And you can see that there's no denying it, that headline inflation continues to cool, coming from 9.1% in June all the way down to 6.4, 6.5% now that we're in, or at least as of December. So clearly that's a good thing. The main question, of course, is will a tight labor market lead to, the reacceleration of the United States economy? Will it lead to higher wage inflation? Well, again, so far, the most recent report says no. In fact, it says it's moderating. Wage inflation is moderating. But again, I mean, this is one of those things that will only be more obvious in a few months. We'll have to see how it plays out over the next few months and see if inflation continues to come down. In the short term, inflation has been coming down quite quickly. The one thing I would potentially look at, we got to take a look just really quickly, inflation year over year. It's been coming down in a very linear fashion. If you take the monthly change, the only real question is it starting to curl back up? Meaning, is the rate of change going to start coming back up to where that it becomes sticky, or will it continue to go down in a linear fashion? I don't know, right? We just don't have enough data points. The rate of change has been slowing down, but if it stays constant at this level, then then this is going to continue to go down in a linear fashion. So it all depends on where does inflation come in here in a week and a half or so. Which sort of brings me to my next point. If you take a look, if you go take a look at the Trading Economics website, okay, so let's go to, it's the wrong tab. So let's go to inflation rate month over month. Last month was negative 0.1%, okay, which was a good thing, especially compared to what was going on over here in 2022. This website, Trading Economics, is suggesting it'll be another negative 0.1% in January when we get this report here on February 14th, which would be a good thing, right? I mean, if it's negative 0.1% again, that'd be a good thing. How is this, has this been an accurate forecaster in the past? Well, over here, they predicted 0.5 and it came in at 0.1. Here they predicted negative 0.1 and it came in at negative 0.1. So they have a mixed track record. Well, what's interesting is if you go to the Cleveland Fed, they're predicting for January month over month percent change of headline CPI to be 0.63%. which is quite different than what the Trading Economics website is saying, right? I mean, you're talking about 0.63% versus negative 0.1. But 0.6, I mean, that'd be, similar to what we had in January 2022. So I don't really know who to believe, to be completely honest. I mean, I wish I could give you the answer. I don't know. I mean, do we believe these guys that say negative 0.1, or do we believe the Cleveland Fed that says 0.63? So this is going to be something that I think, and then they're currently suggesting that February is going to be 0.49. Of course, we only just started. This number is subject to change. I think they update it basically every single day. But this is a pretty big number. So we'll see where it comes in. We'll see who's right. Is it the Cleveland Fed? Is it Trading Economics? Maybe it'll be somewhere in between, right? Maybe it'll be somewhere in between negative 0.1 and 0.63. But if that does come in hot, then I imagine you would see the interest rates, the Fed funds rate, probably price in a higher terminal rate, meaning, market would probably become a bit more sure that it's going to hit 5.25. And right now it's kind of all over the place. It's moving back and forth. 48% chance of 5.25 by May. But I mean, by the time you're watching this video, this number could be a lot lower, could be a lot higher. Market is really starting to digest this most recent jobs report, which again is a bit all over the place, or a bit of a huge surprise to a lot of people as to where it actually came in. Some people don't really believe it, and again, some people just say that it's just not adjusting for seasonality in the best way. So these are the things I'm watching right now, right? So you have a historically low tightness in the labor market at 3.4%. History shows that's not really great for inflation, but the most recent jobs report says that wage inflation is moderating at least a little bit. You have the Fed saying, that they're happy to see inflation coming back down, but Powell still would not like to see this tight of a labor market. So despite the Fed's best efforts, the labor market remains historically tight. So because of all that, markets are saying, all right, you're right. It's going to be a 25 basis point rate hike in March, and maybe it'll be another 25 basis point rate hike in May. Okay. Beyond that, I mean, you can go out to June, and there's still the market doesn't not really think we're going to go to 5.5, at least not anytime soon. Maybe by July, there's a 20% chance we're at 5.5. Clearly, the market does not think that's the most likely outcome. By July, they're saying it'll still be at 5.25 as the most likely outcome. So then where does this fit in? Because, we've talked about this idea of, is the United States going to head into a recession or not? And I mean, of course, there's a lot of indicators that suggest it eventually will. But again, don't look in the labor market for it, because the labor market is not showing that right now. If you guys remember, we put out a video, I think maybe a few weeks ago, on the smooth recession probabilities chart, and I wanted to provide an update to that. So this chart talks about, it's a dynamic factor Markov switching model, and it's using non-farm payroll, the index of industrial production, real personal income excluding transfer payments, and real manufacturing and trade sales in order to figure out what is the likelihood that we're in a recession. As of December, the likelihood is 5%. Now, you might say, well, 5%, 1 in 20, I'll take my chances, right? I mean, and I agree. The likelihood that we were in a recession in December 2022 is not very high. So do we just completely discount this? Well, the one thing I would say is that this is the highest it's been since the financial crisis, right? I mean, like, look at it like this. If you zoom in to 2011 and we just look at where it's been since 2011, I mean, it's been hit really, really low. And now it's shooting up almost 5%, still relatively low. And there have been plenty of times where we had these sort of false readings where it went up, the market went down, but as high as 10 or 11% here, and we did not go into a recession. So this was what happened in 2005. If we go back even further, you can find another example of it here. Market was still going down, but we went up to about 13% probability of a recession. The other instances where it went up, well, I guess here's one more. Here's one more instance where it was a 30% chance, and we did not actually go into a recession. So you can find 3 examples where the probability went this high or higher, we did not go into a recession. The other examples all did. So this is something we're going to have to keep in mind. Now remember, this includes non-farm payroll, okay? And non-farm payroll just blew out expectations, absolutely annihilated it, all right? And so, this is going to be a positive thing, okay, for avoiding a recession, at least right in the short term, right? Now remember, the smooth recession probability indicator only updates once a month, so it updated like yesterday before the jobs report. So it updated before we got this most recent data point on non-farm employees. So with this data point, the probability might actually be a bit lower, but we just have to take it 1 month at a time. The other, of course, there's other data points, such as the index of industrial production, which has been not doing so great, right? Like if you look at the monthly change of that, it's been dropping. Okay, so that's been sort of contributing to why it thinks there's more likely chance of going into recession. If you look at the prior times when it was this low, or going below zero, say like a 3-month estimate of the weekly change or the monthly change. Again, it normally corresponds, not always, right? There's some false readings, but normally you'll see you might see a recession in that sort of regime, especially if we hang out there for a while. So the point is if you want to look for signs of a recession, you can find them everywhere except for the labor market. Okay. And the labor market is at a secularly low level at 3.4%. That means that the Fed should not be that worried about raising interest rates a little bit higher. There's always a chance they might have to slow down before people think if something comes out and it says, or if something's breaking somewhere, then maybe they have to stop before we actually get to what the market is pricing as a terminal rate. But until you see a slowdown in the labor market, I think the Fed is going to keep going with 25 basis points until at least until you see inflation come back down to earth. So either a sustained path back to 2% inflation, or you see the labor market start to show signs of weakness. And right now we're simply not seeing that. Okay, inflation is coming down, the labor market is tight, but wage inflation is moderating. We're starting to price in a higher terminal rate, and the market is now sort of digesting what does that mean? Can the market handle it? What does that mean for earnings, etc. So hopefully this video has been useful. We'll just take it one step at a time. And with regards to risk assets, as we said before, right? They've continued to rally throughout January and early February on sort of these hopes that inflation's subsiding without sending us into a recession. And until you see either inflation go back up in a material way, or you see the real deterioration in the U.S. economy, potentially via the labor market, it could be via earnings if earnings are very bad. But a lot of times earnings bottom after stocks do. So earnings would have to get very, very bad for that to be the only reason, I think. So you'd have to see the weakness in the labor market, or you'd have to see earnings come in well below expectations, I think. But these are all things to consider. And the other thing we showed on the most recent video that I think is important to follow is the financial conditions, right? Liquidity and excess liquidity, I think is useful for navigating financial markets as well. So we'll continue to keep an eye on that. But again, thank you guys for tuning in. Hopefully this video is useful to you. Make sure you subscribe, give the video a thumbs up. Check out Into the Cryptoverse Premium at intothecryptoverse.com, and I'll see you guys next time. Bye.